And Phil, we're live.
Very much. Well, welcome everybody. It's week 10, I think, Chris, of us doing these weekly webinars, and they have been fascinating. Probably one of the best things that we've done during this period of time when we've all been stuck inside our homes. Each week, for those of you that are joining us for the first time, we've started with one of our partners, Morgan Nyan, who is a national expert on PPP and all things stimulus, giving us an update. And it seems like every week it's another huge update. And we are very grateful that Morgan is with us here today again. And we've gone around various parts of the economy. We haven't covered the entire economy yet, but we've looked at tech, and we've looked at education and cybersecurity, healthcare. And each week we've had an amazing panel that we've been able to gather up to talk about how this current crisis that we're in now has affected that particular part of the market. And we've also had a fascinating time looking into the future, as we've seen a lot of existing trends get accelerated in a very short period of time during this crisis, and got to have fun talking about and thinking about, of those trends that have been accelerated, which one of those are going to stick when all of this is over and we get back to something that looks more normal than what we find ourselves in now. And today's no exception. Today we're going to talk about insurance. And we have another great crowd here joining us today. So thank you, all of you that have been joining us week after week. And if you're joining us for the first time, I hope you'll join us again next week. So on our amazing panel today, we have Amy Stern from FTI Consulting, outstanding company, where she's a managing director, and she's in the global insurance services practice. We have Joe Pizer, executive vice president and global head of broking at Willis Towers and Watson, another outstanding firm. And we're very happy to welcome the insurance commissioner from the state of New Hampshire, Chris Nicolopoulos. And so it's great to have our panel here. And I think, Chris, let's just jump in. It was a big day yesterday with the PPP, and I know you were anxious to ask Morgan some questions here.
Yeah, I think we were. Thanks, Phil, and welcome everyone, and thanks again to our panelists. I think we were sort of worried that we wouldn't have much to talk about with Morgan this week until yesterday, when the PPP Flexibility Act cleared the Senate and is now awaiting signature by the president. So Morgan, what do you think is timing on the PPP Flexibility Act becoming law?
Thanks, Chris, and thanks again for having me. I'm really, it's been a great way to connect with our clients and talk about the updates to the PPP program every week. So the president is expected to sign it either today or tomorrow. We gave a pretty good preview of this, I think, last week for folks who tuned in. The House passed it last week, and the Senate passed it by unanimous consent yesterday. So it should be a law any day now, either today or tomorrow is when we expect that to happen.
So Morgan, I guess the follow-up question to Chris's question is, what are the most significant changes that the Act is going to make to the PPP program?
Yeah, so this is a really great fix to the program. The biggest thing is it extends the covered period for forgiveness from 8 to 24 weeks. So that's a huge difference, and the effect of that is going to be that most of these loans are going to be completely forgiven so long as they're spent for approved purposes, because you now have 24 weeks to spend money on payroll costs instead of 8. And that gives people flexibility, because there are some of our clients and some PPP borrowers still are not open, but they have a PPP loan and they've wanted and expressed interest in extending out their ability to use those funds. So maybe they want to use it when they open back up in July. They're able to do that now and still have those costs be forgiven. So that's the biggest, most important change that this makes. It also changes the 75% rule. So as it is today, before this becomes law, you have to spend up to 75% of the forgiveness amount on payroll costs. They've changed that to 60%. But I am going to note there's a pretty significant issue with the language that they've used. So it says the borrower shall use up to 60% of the loan on payroll costs. And interpreted literally, if you don't use up to 60%, then there's a potential that you could get no forgiveness of the loan. We don't think that was the intent, and we hope that there's some clarifying FAQs that come out from the SBA that makes it clear that partial forgiveness will still be an option. But Until that gets clarified, just watch out for that. You want to make sure that you're hitting that 60% mark for payroll cost, just out of an abundance of caution until we get some clarification on that. And then the last big update is there is an extension to the safe harbor period. So as it stands today, until this becomes law, you have until June 30th to restore your employee headcount levels in order to have that not affect your loan forgiveness. And that's been extended out all the way to the end of the year. So December 31st, 2020. So it gives you 6 additional months to restore your headcount. So that's much more in line with the facts that are on the ground today, and it provides a lot more flexibility for borrowers. So it's definitely much welcome changes. So we just put an alert out on that today, so you can take a look at the specifics. There's a couple other important details in there, and you can find those alerts on our website.
So Morgan, that June 30th date is really kind of meaningless at this point, given the change.
As soon as the president signs it, yes.
Right. And then, so my understanding is there's still a relatively significant amount of money still available in the second slug of PPP. Are loans, can borrowers still apply for loans?
Yeah, there's still, by our count, there's still about $100 billion left in the second tranche. So if you've been on the fence, the program has just become much more attractive. So you can still apply. It's still the case that you can only get 1 loan per borrower. They may change that, though, because there doesn't seem to be as much demand for this second tranche of funds. I think partly because people have become a little bit scared of this program because of the way that it's been administered and the rules keep changing and it's hard to keep up with. But this Paycheck Protection Flexibility Act creates a lot of fixes that make the program a lot more attractive. So if you've been on the sidelines, you can still jump in.
That's terrific. Morgan, thank you again for a great update here. As always, Morgan's going to stay on. If you have specific questions about the PPP or any of the stimulus money that you would like to ask, go ahead and open up the Q&A box, and you can type in your questions, and Morgan will stay on throughout this session and try to answer your questions. And if we don't get to all your questions, Morgan will definitely follow up with you afterwards. So, Morgan, any other thoughts you want to share with us, or is that the full extent of the update?
That's it for today. It definitely keeps staying tuned. I mean, we expect there still to be FAQs and interim rules that come out over the next couple of weeks that further clarify this new part of the act, and there's still a lot of questions that haven't been resolved with respect to the prior guidance. So it's still an evolving situation, so stay tuned for updates. You're not getting rid of me yet.
We sure will. Thank you, Morgan. I really appreciate it.
Thanks.
All right, so we're gonna turn to Amy here and start in on our panel about insurance. And boy, we have a lot of questions here. So, Amy, thank you for joining us.
Pleasure to be here.
I want to start with you and ask you, what the expected claims coverage issues arising from the pandemic are going to look like.
Sure, thanks. And again, thanks for having me, and I hope everybody's doing really well through this incredibly unique time. So as we look to, the different coverages and the coverage issues, I mean, the impact on the insurance industry and the reinsurance industry associated with that is going to be absolutely enormous. There have been varying ranges, but, we're hearing numbers now. This could be an event, in the $80 to $100 billion range for the insurance industry. So breaking things down a little bit, I mean, obviously the big elephant in the room is business interruption. Insurers have been very clear, very resolute that, the vast majority of their policies do not cover business interruption losses arising from a pandemic. And it could be a whole separate webinar about the issues surrounding it, the coverages, whether or not the virus has caused physical damage, which is a condition precedent to having a business interruption claim paid in most cases. There are also issues around exclusions in the policy. How clear are the exclusions? Is there an explicit virus exclusion? Is an insurance company relying upon a pollution exclusion, et cetera? So, a whole host of issues, but generally speaking, pandemic was not intended to be a covered peril, if you will, under business interruption coverage. Having said that, there are explicit cases where there is coverage, and the insurers have every intent of paying those. So, at the end of the day, even though we we'd hope that insurance contracts are simple and straightforward. The bottom line is that they aren't, and we really do have to look to each individual policy really to determine whether or not there is coverage, and there's plenty of litigation already in the industry. But, you know, the big question right now, which, you know, generally speaking, everybody thinks is, you know, going to go away, is will the government decide that they will retroactively determine that even if there are exclusions and certain conditions that aren't met according to the terms of the insurance contract, that those will be thrown out and that there'll be retroactive coverage for business interruption. And to, you know, kind of put this in context, and, you know, to me, the numbers really illustrate probably better than anything why this was never intended to be covered by business interruption policies. The insurance industry, give or take, a little bit less right now, but the insurance industry as a whole has about $850 billion of surplus of capital. And when we think about the size of the monthly business interruption claims, even for small businesses alone, you know, and depending upon what numbers you look at, anywhere between, I've seen numbers from, you know, 200 billion to 400 billion per month, you're not talking about a whole lot of time before the insurance industry would be insolvent. And at that point, you know, consumers, business owners, you don't have coverage anymore for your auto. You don't have coverage for your home. You don't have coverage for fire, or, you know, it's hurricane season, started a few days ago. So, you know, it's really quite a big issue. So that's kind of the business interruption piece. But that's not, you know, that's not the only thing that's going on for insurance companies. Just a tremendous number of claims are already happening, and a tremendous number of areas that could be critical for insurers in terms of the losses that they are going to have to pay as a result of the pandemic. I'll just quickly touch on some. But, you know, event cancellation. It's not a line that's written throughout the industry, but it is a line that's written. And I just saw indications expectation is a loss of over $1 billion to the insurance carriers who do write that cover. You've got all kinds of knock-on effects from what's happening in, you know, in credit markets and, you know, what's happening generally with liquidity, et cetera. So if you look at what we call the credit-related lines of insurance, like surety or trade credit, these lines of business had some pretty severe losses through the credit crisis back in 2008. The expectation is that things could be, you know, much more severe this time around, and claims are coming in very, very fast. You know, you only have to open any news blurb to see the number of bankruptcies and, you know, see all the issues that are going on in credit markets. So that's going to be a tremendous amount of additional unexpected loss, if you will, in the insurance industry. Workers' comp, huge unanswered question. Is the whole bucket of workers' comp loss going to be, you know, greater or lesser as a result of the pandemic? And there are arguments on both sides. There is, you know, certainly a lot of state legislation saying that, you know, there's presumptive cover for essential workers under workers' comp. You don't have to prove that you caught the virus at work if you're an essential worker. If you're sick, you know, workers' comp comes into play. There are issues around family members. If that worker then spreads the virus to family members, you know, what are the suits there? And there are questions around whether that's going to be a big general liability issue, or, you know, there's the potential for it to be an employer's liability issue. People don't talk a lot about the employer's liability section of workers' comp because it's very, very rare to have claims under that. This may be a unique situation. And unlike workers' comp, which has, you know, limit based on, you know, the state benefits, employer's liability does have a limit. And then companies' commercial umbrella policies come in above that. So it's going to be very interesting to see how that plays out. You've got the potential for hits on cyber. We're in a new universe, a lot of security questions. Everybody's working on a laptop, et cetera, much more vulnerable depending upon how strong the security systems are in various firms. So that could be an area. Directors and officers liability. What happens there? General stock market, huge fluctuations aren't the basis for D&O claims typically, but what are companies saying? What are the statements that are being made? Are they misleading? Are they somehow, misrepresenting something? So, we've already seen quite a number of cases resulting from D&O. General liability. What happens with companies, especially now as workers are starting to come back? Are they taking appropriate precautions? Are they following the rules and regs? That's going to be very interesting to see what happens on the general liability side. You have employment practices liability, another area where you could have a potential for claims. Was I mistreated because, I was sick and, the company did something that wasn't quite right? I think one of the big questions is going to be what happens with this very casual working environment, right? All our meetings are taking place on Zoom calls and, everybody's kind of wearing their T-shirts and maybe the T-shirt says something or, maybe somebody has something offensive on the wall. I mean, it's going to be very, very interesting to see in this more casual environment what happens to the general employment environment. And then, of course, we have a whole host of professional liability areas for professional liability claims. How much immunity there may or may not be for essential businesses. It's a big question, and usually even with some level of immunity, there's never immunity for gross negligence. It's been a tough time, right? You've got just unbelievably strained resources, and this is all. It's all very emotive, and when anything happens that's this emotive, that has a tremendous impact on litigation and ultimately on what happens in the insurance industry. And I'll just say that, it's not just on the liability side of the balance sheet for insurance companies, but they're being hit on the asset side. So insurance companies don't typically hold a lot in equities, but they are, like everybody else, like other companies, they're being hit in that portfolio, but more so from their bond portfolios and where some of those credits are trending right now. So that's a hit. They've also got the hit from, we're in a zero interest rate environment. So, the funds that come in, the premiums that come in need to be invested. And if they're just kind of sitting there in cash, if you will, and not earning any return, it puts tremendous pressure on insurance companies to make sure that they're making money on the underwriting side. And despite everybody thinking, and, I don't like paying my premiums either, insurance isn't a high margin business to begin with. It really isn't. And it's been, trending significantly downward over the last few years. So I think expectations are that there will be, significant rate hikes across the board. I think insurance companies really do need to look at their aggregation. There'll be a reassessment of risk management across the board. And I think that will go all the way down to the policyholder and really working with policyholders to do more around loss control. Insurance industry tends to constantly operate through a rearview mirror. Now we have an event. It's not over, and we don't even know if there's going to be a second wave. So I think there will be a lot of lessons learned to apply to the future. And generally speaking, I think it's positive in terms of what will happen. But I think that one of the big questions is how do we deal with this going forward? A pandemic, my opinion, a pandemic as a whole is not an insurable event. It can't be diversified, and that's the basis of insurance. So when you have an event like this that's not diversifiable, you really do need to look to, a tremendous level of, public solution as opposed to private insurance company solution. Certainly, just in the last week, some interesting bills are out. One that has more of a function like the Terrorism Act, like TRIA, called PRIA, to try and deal with it in a public-private way. And another which is more about, having insurers act as the administrators of the policy, but really having a public sector solution to making sure that consumers and businesses get funds when they need it very quickly in a very effective way, as opposed to trying to run it through a more complex, difficult insurance product. So I'm confident they'll come up with a solution, and we'll get there pretty quickly. But it's very tense times right now.
So Amy, it strikes me that, you've just given a very sort of compelling and sort of thoughtful walkthrough of sort of the comprehensive nature of the impact on the insurance industry of the pandemic. And this was foreseeable to a large degree, something like this happening, and so and it's and in an industry, you deal with so many people in the industry, everyone's sort of oriented towards assessing risk and pricing risk and diversifying risk and insuring against risk. Why are we where we are?
So it's a good question. And it's not as if companies haven't, thought about pandemic risk. Certainly on the life side, there are actual reinsurance products that are, very modelable. You've got something that's a little bit easier in terms of trying to predict number of lives lost and that kind of thing. I think a lot of the problem is that, right or wrong, I don't think anybody contemplated this, complete and total shutdown, and a shutdown that was, mandated by the government. And so, what does that mean? To some extent, there's an inherent conflict when you think about business interruption insurance and, loss mitigation. Well, then you should open, which doesn't make any sense, right? So, again, it comes back to when you look at other catastrophes that are very much in the insurance business, that the insurance industry is, stands up, pays the claims, no issues. They're discrete. Something happens, but again, back to the diversification. If a windstorm or a series of hurricanes occurs, the insurance industry can deal with that. This is going on so long, has impacted everybody, every business. It's global. That doesn't even fall into the definition of an insurable event.
So Amy, thank you for that. Just a very sort of practical question, for business owners, the insurance companies in the industry, decisions will be made as to what they cover and what they don't cover. But as a sort of very practical level here, are all of our premiums going up now as we look forward?
I guess I have the benefit of being on the consulting side, right? So I can kind of give you some general thoughts on that. But I think that given the size of the losses that will run through the insurance industry, premiums will go up. What's going on the asset side of the balance sheet, premiums will go up. I wanted to make sure that I gave plenty of time to my colleagues here on the panel and didn't want to take the entire time speaking myself. But there's a whole issue around reinsurance here and what's going on in the reinsurance marketplace right now, and how that drives pricing of insurance products. And as the amount of capacity in the reinsurance industry starts to shrink as a result of what's going on, which is what's happening right now. The natural cat season, the vast majority of reinsurance was dealt with on June 1st, and prices were way up. So as prices, because those have increased, that there will be a trickle down there. So I think a lot will depend on the line of business. It will depend on the company and how impacted they are by this. And it will ultimately depend upon an individual policyholder and what that particular policyholder's loss experience has been through this.
So thank you, Amy. So Joe, what should a company do if they're facing an imminent renewal in this environment? How do you sort of internalize some of the things that Amy's been saying?
Thanks, Chris. And like Amy, I'm very delighted to be part of this panel. You know, Amy very eloquently described the impact of COVID-19 on the insurance industry, and that'll be an ongoing thing that we watch. The other part of it is prior to COVID-19, we had entered a period of rising prices. So we call that a hard market in our business. And that started in early 2019. So we were already in a period of rising prices, and this is going to exacerbate that pretty significantly. Phil had asked, are our premiums going up? The short answer is yes. They're going up in virtually every line of insurance, property casualty insurance, with the possible exception of workers' compensation. That's been a very stable line of business for the last 5 years, but even that will be under some severe pressure as we see the COVID-19 claims work their way through the workers' comp system. But the good news is that there is still the ability to differentiate your company in the insurance market. In our experience, the range of renewal results is actually quite wide. So what I mean by that is if we're seeing an average rate increase of call it 20% in property insurance, we're seeing some rate increases as low as low single digits, but then others as high as 70 or 80%. So there's a very wide range of results. And what that means is that insurers are taking the time to actually underwrite each and every company. So if you are facing a pending renewal, like if something is coming up, and insurance renewals tend to come up quickly for a lot of companies, it's really important that you prepare. Your companies are in periods where you are reducing payrolls, where the values of your business interruption, these are things that determine your premium. Your values are going down, your payrolls are going down, maybe your automobile traffic is going down, but some things might be going up. And it's really important that you have a really good handle and some rigor behind how you calculate these values that matter to your insurance premium. It's not good enough to go into an insurance company and say, well, I think my values are down about 50%. They're not going to give you the proper credit unless you can show some rigor. If you show some rigor, you'll get the proper credit, so it's worth the time. In addition, there are often parts of a policy that are not really paid attention to except in strange situations. So, for example, a lot of insurance policies have what's called a minimum premium, right? So that's the minimum amount that you would pay regardless of how your payrolls change or your revenues change, et cetera. Well, you can negotiate that downward in these conditions to make sure that your program flexes with your actual business results. At the same time, you don't want to underinsure yourself. You might have your business might be shut now, but maybe it's going to reopen in the middle of hurricane season, and you want the ability to flex your program back up as your business comes back. So you can negotiate midterm reviews of your exposures to make sure that they're right for your company, right, as you shrink or as you grow. So these are things that don't normally get paid attention to in regular times, but they're really important now. At the same time, the insurance business is very much a data-driven business. It's very much a statistical business, and there are very sophisticated models available to model risk and estimate risk, et cetera. Well, those need to be refreshed. So if you're working with a consultant or a broker, make sure that they're refreshed based on your current situation. You don't want to find yourself overpaying for things that your business just isn't doing today. So that's a really important thing. Make sure you plan. Make sure you give yourself enough time. We're all sitting at home, but video conferencing works as this event shows, right? So I would really encourage the participants here, if they have an insurance renewal, to use video conferencing to actually meet with their insurance company. It works. It helps you differentiate yourself. It helps you explain how your business is doing. And it's as close to face as you can get. And you should be prepared to talk about not only your business plans, but what is your liquidity? Insurance companies care about that because your liquidity impacts a number of things. It could impact how much money you're putting into safety, how much money you're putting into maintenance, things that affect your risk. And if you have a good story to tell, you should be on video telling that story. In addition, we do have a worldwide insurance marketplace. There are insurers all around the world who write U.S. business. There's quite a few in London. There's quite a few in Bermuda. There's quite a few in Switzerland. There's quite a few in Singapore. And you could meet with those underwriters on video conference. You don't even have to travel. So I would really encourage everyone on the phone to plan ahead, have a plan A, but also a plan B and a plan C, because in this marketplace, things are pretty volatile.
Joe, that's a really interesting point. We talk with our clients in M&A transactions in the context of the transactional risk products to really prepare and be able to put a crisp presentation across to the insurer to demonstrate the diligence that they've done in looking at an opportunity or presenting an opportunity to a buyer. And, we found it has made a difference. And so it's very interesting to hear that from your perspective, it makes a difference in, and can make a difference in sort of other areas of coverage as well.
It will. It absolutely will. I'd also like to say, Chris, I talked a bit about what to do about a tactical pending renewal, but there's also, I think, an opportunity to step back and look at your entire insurance portfolio with a fresh set of eyes. When you're in a period where prices are going up and your own resources are going down, it becomes important to think about where is the best place to spend your next insurance dollar, or where's the best place to save your next insurance dollar. And if you look at your insurance programs one by one, property, casualty, D&O, et cetera, you'll make certain decisions. But now's the time to sort of step back and look at them as a whole and look at your own portfolio of risk. Every company's portfolio of risk is different, and the interaction of those risks are different. And there's very sophisticated modeling today that you can take a look at your entire portfolio and determine, I'm better off taking a higher deductible on my property program and a lower deductible on my general liability program, or maybe I don't need to buy as many limits of insurance for my medical malpractice program, and I should spend more on my umbrella program. And look at it as a whole. And now's the time to do that, because not only are the models available, but everything is changing so much. The exposures are changing, et cetera. And the costs are real. So the ability to save and optimize your program is very real.
Joe, I want to ask you about insurance lessons learned. Talk to us about what the industry has learned from this pandemic.
Okay. Amy talked about how business interruption is the elephant in the room. And that is an indicator, and I think everyone at Nixon Peabody would agree with this, that words matter. In our business, words really matter. And it is worth the time to read your insurance policy, understand it, challenge your broker, challenge your insurance company on the words, get advice on the words, get comparisons on the words, because as Amy said, the vast majority of business interruption policies are not covering this pandemic, nor are they intended to. But there are some policies that are there are some policies that are covering it. There was the ability to purchase broader coverage, and those policies will be paying. They already started paying. So words really do matter. The other thing that it shows us is that, just like 9/11, it shows that black swan events do happen. And insurance, it might frustrate a lot of the folks here on the phone, but the reality is that for the most part, it is a great tool for resiliency. It is a great tool to get quick liquidity, to protect your P&L as well as your balance sheet, and be resilient. And I think that capital around the world, as it looks for where to invest, it will look increasingly at the sort of enterprise risk that the company has. And part of that is insurable risk. And I think as capital looks for resilient companies, insurers will be a big part of that. And the insurance rates will be better for those companies that can show that kind of resiliency.
So, Joe, you talked a little while ago about the models that are available for people who are, consumers of products and evaluating their needs. Do you foresee sort of better, perhaps more strategic ways for carriers and other players in the industry to help build better programs in the future?
I do, Chris. I think that, as I mentioned earlier, we're seeing a wide range of results, which means insurance companies, particularly the sophisticated insurance companies who work with corporations, are not just taking a broad brush. They are actually differentiating the clients and trying to find the better risks, and that presents an opportunity to differentiate yourself, as I said. But in addition, the business is very data-driven. And the insurance business is now pretty well connected to the capital markets, right? So Amy mentioned that, we have about $850 billion in surplus capital in the P&C industry. Well, the capital markets has trillions of available capital. Now, they're not going to just flood into the insurance business. Well, one thing we know about the capital markets is that they themselves are very data-driven and very conservative. So as we develop more sophisticated tools to model risk, we can attract some additional capacity from the capital markets. And we're seeing that happen already, and it's going to continue to happen, and it's going to grow. So, for example, there are things, they're called parametric trigger programs. So instead of buying an insurance policy that covers your risk for an earthquake, you could buy what's called a parametric trigger, which responds immediately when there's an earthquake that meets certain conditions or certain criteria. And that's actually a capital market type of policy. And I think we're going to see more and more of that as time goes on. They'll be much more sophisticated, and will make those companies who have a really good handle on their own risk able to access more efficient capital to transfer that risk.
Thank you, Joe. I want to bring in our commissioner from New Hampshire now, and Commissioner, I know that you are a recent appointee to New Hampshire Insurance Department, but how is the department functioning in this COVID era?
Thank you for the opportunity to be on the panel. It's been an interesting 13 weeks as the new commissioner here in insurance, because I had about 10 days before all my staff went home. We're currently operating at about 20% of essential employees here in the department. So 15 or 16 are here and 60 are working remote. We were fortunate as a self-funded state entity that we had the technology to move our staff out. And we've kept all core functions operating. We're still meeting our kind of goal metrics for rate filing review, for company financial investigations. Licensing has been a bit of a hiccup because for a while there was no ability for new agents to get licensed. But the department responded pretty well to this kind of surprise work from home event.
So Chris, we've talked, Amy and Joe have each talked in turn about business interruption insurance coverage, and obviously that's gotten a lot of press in this environment. And I know we were chatting before the session. It's been a particular point of emphasis for a lot of the communication that your office has received. Have you provided any guidance regarding that for either policyholders or carriers?
Yeah, we have here at the department, and we did it pretty early. I don't have a lot to add to what Amy and Joe said, because I think they were dead on with the direction that we've given folks, which is policy language controls that many companies use, standard ISO forms that envisioned the potential for a pandemic and excluded that coverage. But we directed folks to look at their policy language to see whether or not they were using standard forms and whether or not it did require an underlying property loss to kind of trigger business interruption. And then to add to that, I've had a few opportunities to speak with legislators here in the state who considered very much, should we draft a retroactive requirement for business interruption? We weren't the only state that had legislators looking at that. And I think our department pretty strongly advised against it because of what that impact would be to the marketplace if you required coverage of events that premium wasn't charged for. And though it's, as a regulator, it's not a kind of great political kind of position to take, but one of the constituencies I need to protect is the financial stability of the insurance companies. And there is no perfect answer. I think a program like TRIA that was mentioned earlier for these kinds of losses, for those insurance consumers who want coverage for a future event, may be the only way to really adequately cover any of these large-scale potential losses.
Commissioner, we've heard lots of news regarding premium rebates from a number of insurance companies, I think primarily auto. How is your department handling these rate filings?
We got out ahead of these premium rate reductions as quickly as possible because we saw this as a unique opportunity where a number of auto companies originally said our claims have fallen off and we have the ability to return money to consumers. And though it wasn't, in the vast majority of cases, it wasn't even envisioned that this could happen, we found a way to approve rate filing reductions in New Hampshire for about 94% of the personal auto policies. In the first month, I think that returned about $30 million to New Hampshire auto policyholders. Since then, we've seen a number of those companies extend their premium rebate requests to additional months. And as of today, we saw the first filing for a health carrier here in New Hampshire who is looking to return up to 15% of health premiums for the month of April to, I think it's going to cover 75,000 lives here in New Hampshire, maybe $6 or $7 million in premium credits because they're experiencing, much like the personal auto, they're experiencing a pretty drastic reduction in claims. We've seen a few premium reductions for commercial auto and commercial business policies, but the department, I think our average turnaround on one of these rate filings has been about 24 hours, so that we're not in the way of getting some relief back to consumers. The health filing we saw today also included a 50% reduction for the April dental policies under the same, I believe that was an Anthem dental plan, a 50% reduction for April premiums as well. I think it's a unique opportunity to get money back, and we've encouraged the companies that are in a position to adjust the premium charges based on actual losses to do that.
Well, it's interesting. I was chatting a week or so ago with a friend who is in the international insurance space, and that person was saying that a number of subsidiaries in countries where COVID had hit earlier sort of noticed a significant drop-off in claims during the stay-at-home period, obviously, but then an inordinate sort of increase when things opened back up because people were avoiding public transportation. There were a lot more people on the roads. So I'm wondering if we're going to see a little bit of that as things reopen, and you know, sort of what the thinking is there, because obviously people aren't going to be able to claw back anything on the other side of the equation.
I think that's a good point. I haven't seen any data about that, but that doesn't surprise me that more people might be driving on the roads, and to a certain extent, they're rusty. You know, there are people who haven't been behind the wheel of a car in 12 weeks, 13 weeks. And I think regarding the personal auto reductions, I think the company, the 15% that we've kind of seen, 15 to 20% reductions, I think that those were really conservative numbers. I think they actually saw reductions vastly higher than that, but 15% or 20% was a safe number to give back, and at this point we've only seen 1 or 2 months and not 3 months, so hopefully they have adequate reserves for whatever blip there is. I think that will be very different for the health carriers. The health carriers have seen a drastic fall off in claims here in New Hampshire. You know, the limited number of COVID hospitalization cases and the COVID testing cases are not offsetting all the kind of elective surgeries or traditional doctor's visits. But the experts are telling me that those will just be delayed. Absolutely, those procedures will have to happen in the fall, and to a certain extent, they may even happen into the next policy year. And so as we're at the point now where we're working with companies on rate filings for next year, and I'm not envious of them trying to determine when that kind of pent-up demand for health services will actually get scheduled.
Commissioner, health insurance companies, right? I mean, they're right in the middle of this, and like many other businesses, trying to get their arms around this changing world here. So, interested to hear what you're hearing. What kind of concerns are you hearing from health insurance companies?
Yeah, I've probably spent the most time directly working with our health carriers over this COVID period. I have a call with the full leadership team of each of the 5 health carriers here in New Hampshire every other week, and we spend an hour with my entire health staff and them just working through the issues, from simple things like initially I issued an order that said they must cover COVID testing and treatment without cost sharing, because early on we wanted to ensure that people weren't making a financial decision about, do I go to an emergency room and determine whether or not I have COVID, because I don't want to pay the emergency room copay. And we wanted to ensure that those folks that needed or deserved a test were getting those. And the companies embraced that because they felt like for kind of community health and safety that made sense. As we've transitioned, though, there's now, as of last Friday, anybody who wants to get a COVID test here in New Hampshire can get one by scheduling it, whether or not you meet kind of the traditional CDC guidelines for qualifying for medical necessity for getting those, and so we're still figuring out where that cost should be borne by the state as just community survey testing, where it is a covered event under health insurance, and then in cases where you can't come back to work until you've been cleared by a doctor, is that a work requirement and not health insurance at all? And so we're working closely with the health carriers. They've been wonderful partners in this. They realize that we have a united interest in ensuring that the New Hampshire COVID crisis is contained, and to the extent that they can help cover those costs, they've been great doing it. but as the number of tests go up, the requirement that an order from a doctor is there, it's in kind of important for them to understand what obligations we're putting on them to cover that. Also on the health front, we've seen a tremendous shift from traditional doctor's visits to telehealth. I believe one company reported from May of last year to May of this year, there was a 3,000% increase in the number of telehealth claims that were approved by this carrier, and kind of updating all their systems and updating their relationships with healthcare providers to ensure that people had access to telehealth for the kinds of things that they wouldn't have typically had access for, whether it be phone only, whether it be the kinds of service like PT, where you typically think you need to be in person. There's been a lot of flexibility on the part of the health carriers to ensure access to some kind of medical interaction. The companies have been really flexible with their insured employers on premium payments, on payment windows, so that people remained covered during the kind of unknown, during the financial kind of constriction. And we're hearing positive things about companies that sought some flexibility but have been able to pay, maybe in part because of the PPP money, maybe in part because they're getting back to work. And we have not seen as many, and this is good news, we've not seen as many employer-sponsored cancellations that we anticipated we might see early on. And so they've been phenomenal partners with us in the department and the governor's office.
So Commissioner Joe mentioned earlier in his comments that the workers' comp marketplace has been a relatively stable one of late. But what impact do you see this crisis having in that space, in that particular line? I
fear that, I think we've had 8 or 9 years here in New Hampshire with stable or reduced comp costs. And this is kind of a double barrel attack on comp, because one, you have less people working, and so presumably less premium paid, and the questions about comp-related claims, both for people who would naturally, have coverage as a work-related injury for contracting COVID, maybe hospital workers or such, and those who wouldn't. Our AG last week in New Hampshire, on the 22nd, issued a bulletin of guidance on their interpretation of when workers' comp would be would and wouldn't cover potentially employee-related COVID medical expenses, and I think that will provide a pretty good roadmap to employers who are concerned with whether or not their employees would have a comp claim against them for contracting COVID. We did issue we did have NCCI issue an update to their rules here in New Hampshire, so that employers who were furloughing employees but were able to continue paying them because they didn't want to lose key employees, where they didn't have to continue paying comp premiums on those. It was a new status class was created that we hadn't had before, status class 12, which included both no payroll number and no rate for those employees who are getting paid but not working. And so that will have a premium impact here in New Hampshire. Though rates in New Hampshire for workers' comp have been going down year after year, the comp marketplace has been pretty stable, and so we're watching that very closely.
Commissioner, thank you. I think we have time for one more question, which we can just open up to the whole panel here. My big takeaway is still premiums going up. I'm sort of stuck on that, but I don't want that to be our last takeaway. There's been a lot here. So I guess my question is, I'm interested to know, are there coverages that insurance companies are working on now to fill in some of the gaps, going forward? If any of you are interested in talking a little bit about that, just sort of open it up to you guys.
Sure. Now the most fertile area is in cyber. Okay. Cyber is in the scheme of insurance or in the time frame of insurance is still a relatively new product, but it's been around now for a number of years, and cyber affects every part of a company's operation. So cyber risk is prevalent in every part of the company's operation, and making sure that cyber insurance and your other property and casualty insurance policies dovetail is very important. So I think we're currently seeing a lot of development of different coverages that are specific to an industry and cyber related. So I would say that's an area where the insurance industry is kind of really ahead of most others in reacting to that kind of emerging risk.
Amy, you want to jump in, or?
Sorry, I've had a little muting issue. Sure. No, again, I think that, in defense of the insurance industry, when these things happen, insurance companies really want to do what's right, and they want to come up with solutions. So I think you will see an increase in certain types of products to deal with, certain scenarios. Joe, I love that you mentioned, parametric triggers. Interestingly enough, it's not something that's been, particularly highlighted, but the World Health Organization actually had a pandemic bond out in the capital markets, and it was fully triggered, and it enabled funds to be delivered to them. It's $200 million, but it enabled funds to be delivered to them, very quickly, and then out to the market. So I do think we will see a proliferation of that type of structure. Tapping the broader capital markets, really interesting. Something that I spent a lot of time at Willis actually working on in the capital markets group. It's really interesting. Investors can make investments in insurance companies, or they can make investments in insurance funds. And you see a lot of this in the natural catastrophe market. There's an interesting question around how broad that will be in something like pandemic cover, mainly because, again, it's not a diversifying event. Natural catastrophe is very diversifying for a capital markets investor. The pandemic's been, just hitting everything. So it will be interesting to see what happens there, but I would expect some good creativity, certainly coming out of friends at Willis, and we're certainly working on some interesting things at FTI as well.
Well, Amy, Joe, and Chris, thank you so much for your insights today. It's hard to believe that our hour has gone by, but in fact it has. I find myself frequently having that experience in these webinars when we get to hear from such terrific, smart people with really useful insight in the topic. So thank you again, all of you, for being here.
Thanks for having me.
Thank you very much.
And by way of reminder for our audience, in addition to this webinar series, we've been holding a variety of timely programs across many areas of interest. For instance, on June 10th, we're holding a tax-focused webinar that will discuss how companies can navigate the complex tax implications of the economic recovery. And on the 11th, we're holding a final webinar in a three-part series focused on opportunity zones. And so that webinar is ideal for sophisticated investors or developers who are interested in the opportunity zone space. You can access all recordings from all of our past webinars and register for upcoming programs and sign up for alerts in our mailing lists at www.nixonpeabody.com. and you can also subscribe to some of our other publications there. So we thank everyone for their attendance today, and we will be back to you next week.
Thank you,
everybody.
Thank you.